Hi, my name is Dana Golden. Today we're going to be continuing on in the natural resource economics section of the class with a look at commodity market derivatives. I've said at various points in the class that my goal here is to train you to be junior analysts. I think of you as like a young analyst who was assigned to my desk and really needing to learn the ropes before you can get started in trading or evaluation of projects or environmental consulting or whatever it is you're going to do. So this is, you just started the job and you're learning it. And that's really how I'm going to act today. Is I think of you as, I'm at a trading desk, you came to my desk, and now I've got to start making you get acquainted with commodity market derivatives. So without further ado, let's get to some of the junior analyst training that you can take to the workforce. So let's start with the history of futures markets. The history of finance is about increasing complexity and increasing information. If you think about how equities have developed and how stock markets have developed, you've gone from very simple markets where there was little information and you could exploit information. You would have people who would row boats out to learn about the Napoleonic War earlier and trade on that. And now you have people who do high-frequency trading where they exploit signals in the market in a fraction of a second. So that's the finance, and particularly equity finance, is all about increasing complexity and increasing information. History of the futures markets, though, is also a history of the modern world. Markets started as agricultural markets, then they became metals markets with the Industrial Revolution, and now they're dominated by energy markets and the oil and electricity age. So when you're thinking about futures markets, when you think about commodities, remember that the history of commodities is also the history of the world, because commodities underpin, first off, the agricultural markets and the transition to larger scale food supplies, larger scale supply chains for food. Then the metals markets became the Industrial Revolution, where the Industrial Revolution was in many ways, a metals revolution. And then finally, you saw in the 1950s through 70s, you saw the energy age, which was dominated by oil and natural gas, followed by the electricity age we're in now, where you see a lot of very high frequency, fast trading on electricity. So over time, you've moved towards more and more complex financial instruments, and you moved down the line from agriculture to electricity. So some common language. Spot prices indicate the cost of commodity for a specific location. So spot price is what you pay or receive today for buying or selling a commodity today at a specific place and a specific time. Spot prices are dominated by physical participants and less liquid. These are people who have to buy things and sell things and have capacity to store them, have capacity to grow them or make them. Futures price, however, indicate the price of commodity at a certain preset location, at a specific date in the future. So how much is this commodity worth at this location at some point in the future? Futures contracts tend to be a mix of speculators and physical market participants. So they're significantly more liquid. So physical market participants, there are less of them, kind of by design, and speculators are added on there and play a particular role, which we'll talk about in a moment. If I sell a futures contract, I agree to provide a set amount of a commodity or pay the price of the commodity at a futures date. And then if I buy a futures contract, I agree to pay the price or take delivery of the commodity at a futures date. So some characteristics of a futures contract. You have a quantity and quality of a commodity. You're specifying a grade if it's agricultural. You're specifying a grade if it's metal. You're specifying a fixed amount of energy that the commodity holds if it's an energy commodity. And you're specifying a particular commodity, some amount of bushels or some amount of BTUs or some amount of kilograms. The contract requires initial margin requirements to ensure the investor can fulfill obligations. In our market structure and regulation portion, we'll talk about what happens when this is not fulfilled. But in general, you're required to hold a certain amount of capital to make sure you can actually pay for the contract based on how it's settled. It's mark to market daily, meaning that you always have enough capital to meet yesterday's obligation, regardless of whether the futures contract is settling today. Your expected to have a delivery at the end of the contract period. In Chicago, this is usually the 15th of the month for future expiration, though this can vary by the type of market. When markets are very tight, prices can become volatile around settlement as traders close out contracts. Traders don't like a lot of volatility, and when markets become very tight, traders try and get out of contracts before having to worry about them settling. So normally you see a lot of trades right before the contract expires. And the contract provides a list of acceptable geographic settlement points where you can move things to, usually a list of warehouses where you can store things if you are settling physically. I think most people think futures contracts all settle in kind. There's a famous episode of Good Morning, Miss Bliss, I think it was, which eventually became Saved by the Bell, where Zach Morris decides to trade potatoes using his computer's, his teacher's account, because he thinks they're going to make him a bunch of money based on a flawed reading financial history. And then at the end of the episode, Miss Bliss receives a shipment of potatoes. Some futures contracts definitely settle in kind. Very few of them actually do that. Very few of them actually do that, and very few of them settle in kind, meaning you receive amount of gold. Settling in kind means that it doesn't mean you receive your amount of gold, doesn't mean someone's delivering potatoes to you. It means you're handed a certificate that says you own corn. No one's like shipping corn to you. You have corn in the warehouse. But the vast majority settle in cash. Majority of contracts you have a cash position, and then you pay an amount of cash that represents buying or selling a contract at that price, and you can use that to deal with your physical position. You're not actually receiving the potatoes at that date. Even those that don't settle in cash normally get closed out for contract expiration, so most participants never actually have to deal with having to physically own a commodity. Usually there's a premium for commodities that settle in kind because people like the option to receive physical goods. This is a real optionality. But sometimes settlement in kind trades at a discount. Sometimes people like not having a physical good. This might seem weird, but actually this has to do with moral hazard. So it turns out when you settle in a commodity contract in a physical way, you're kind of incentivized to use the lowest quality of material that you can. So in some markets, these materials end up becoming outdated. Sometimes in agricultural markets, they might become close to expiration date, and some of them are not very good materials. And no one really cares. No one notices for a while because it's just sitting in the warehouse and it works fine for financial settlement. But it's well known in the market that this is low-grade material. It might be that people prefer financial settlement than physical settlement because they understand that actually what's in the warehouse is not really equivalent to what they want to be trading based on, which is where this very weird spread comes in. And there was the famous case where someone traded painted rocks and said it was nickel and put it in the warehouse, and no one checked on it for years. And then the current owner noticed this when they tried to get it out of the warehouse, and they were just stuck with a bunch of painted rocks and very angry at the exchange. Second, we're going to talk about basis. So basis for commodity represents the difference between the cash and futures price of the commodity. In general, the spot price is lower than the futures, and the basis should converge the cost of transportation as the contract approaches expiration date. So basically, the basis, if you think about this map here, basis is the cash price at a particular location, and there's a minus the nearby future price. So the difference from what you have to pay to get it where you are, and the futures price in general, the spot price is lower than the futures price, and the basis ends up converging at the end because effectively the spot is the same as the futures, except the futures contract is transported to a specific location. Basis represents the health of the market. A positive bank basis means that markets are very tight and people are paying a premium to get physical deliveries of the commodity right now. Suppliers really care about local basis. If you ask a farmer in the Midwest about basis, they'll say that very much matters to them, particularly soybeans and corn basis. And basis converge based on local market dynamics. So here's contango and backwardation. Futures prices approach spot prices as delivery date approaches. This can fail when there's a shortage in the market and suddenly a bunch of people are having to sell off or buy to cover contracts because they're worried about exposure. This is like a short squeeze sometimes. So contango means that the futures price is higher than the spot price. Normal backwardation, which we'll talk about now in a moment, means that the futures price is lower than the spot price, and they should both converge to the spot price, plus or minus the transportation cost as you get to time. So backwardation means that the futures curve decreases by delivery date and that the spot price is higher than the futures price. So here we have the spot prices here and the futures prices here. This is normal in most theories because of the time value of money and market inelasticity. You have tight markets now and less tight markets in the future is what you'd expect backwardation. In contango, futures curve increases by delivery date and spot prices are lower than the futures price. This happens when markets are expected to become tighter in the future. This is similar to a yield curve. So you can think of contango as like interest rates are higher in longer periods. And backwardation, I believe, would be considered an inverted yield curve because you have a decrease in interest rate, and then contango would be similar to a normal yield curve. Contango is not considered normal in most commodity markets, but can be driven by the cost of storage when it would be normal. In 2020, price of oil went negative because there was nowhere to put it. So it becomes very expensive to hold the good, and you want to wait as long as possible because storage is expensive. Could you have traded on that? Could you have traded on that? No, probably not, unless you were a physical trader and you somehow had somewhere to store oil. Oil is notoriously very difficult to trade. People were looking at this and they're like, oh my gosh, it's negative oil. People pay me to take oil. Yeah, that seems hard. You have to have the license. You have to store oil, which is not easy. And also, I should mention, oil, like, you can't just store it at normal room temperatures because it will evaporate, and that creates a mess. So how can contango and backwardation exist at all? Why isn't there just one price? Doesn't predictable shift in market prices violate the efficient market hypothesis? Why isn't someone arbitraging this away? It's very possible that every price on the curve is correct, even though you have different prices across time. Storage is not free, transportation is not free, investments have to be tied up to shift across time. So there's a cost of arbitrage, and there are all these frictions that even if market is efficient, mean that the price is not going to be equated across time. And even if there is like a price imbalance, the cost of arbitrage might be less than the expected benefit. So can contango and backwardation exist together? Can the curve be in contango in some time periods and backwardation for others? Of course, this is normal because seasonal variation in some commodities. You might expect prices to rise for some goods in the summer and then fall later. So you might see some portion of the curve in contango and some backwardation. Even without seasonality, it's normal that contango and backwardation exist when markets are tighter in the medium run than the long term due to longer market dynamics. So you might expect prices to go up in the beginning and then fall precipitously as the market responds. So let's talk about who is participating in this market, who comes into this. First off, we can talk about hedgers. These are physical market participants. They have an economic interest in the commodity. These are people who are interested in trading contracts because they care about the price and they don't want to be exposed to this type of price risk. And then you have speculators who are purchasing derivatives with the goal of predicting price movements and making profit either on the fact that hedgers need liquidity or because they have an opinion about how prices are going to move. Speculators only have a financial interest in a commodity. You can be both a hedger and a speculator because you might want to hedge the physical position slightly, but you might also have an opinion as to how prices will move. So value of speculators improve market liquidity. More information is good. So speculators in a market are incentivized to trade with people, lower the bid-ask spread, and provide information on the market, do their own research. Speculators stabilize the market, remove seasonal variation because they're in the market to arbitrage, and there's an imbalance between prices across seasons, speculators generally help smooth out the prices. Speculators can also cause bubbles and create distorted signals in markets. Physical participants in commodity markets tend to be very keen on what the price is and very keen on not making bets. Speculators, because they're making bets, inherently might choose to buy at a price they don't believe in because they believe that the market will deal with it later. Speculators are not inherently bad, but uninformed and irrational speculators may negatively impact markets. We're going to stop here, and we'll continue next time with a continued look at the fundamentals of derivatives.